Hello, this is Bill Moreland with Bankreg Data. Today we're going to take a quick look at Peapack Private Bank and Trust. This will be a hopefully brief update to an earlier article that I did going all the way back to December 16th, 2024. And during this is a periodic review we do in our article section where we talk about various things. One of them is we'll do a bank review and we'll do the good, the bad, the ugly kind of theme on it. And just kind of coming back down here to take as a reminder, what we had is there were a few things we were concerned about that we kind of put under the bad category. Is their non-performing loans were increasing. And this was as of 3 quarters ago. They were up to 156 basis points, 151. But what we were seeing was they were starting to do a lot of loan modifications. And the key point here is used with restraint. I'm a fan of loan mods. The problem is it's a gateway drug. And so once a bank steps across that process, so what we're going to do is we're going to take a look at Peapack. And no surprise here, it's exactly what they're doing, right? So if we come in and we look at our various tools, one of the things we see on our tear sheet here is a lot of orange. And the orange is going to represent this bank is in the bottom 20% nationally. So we see that they have a very large NPL rate of almost 2%. So their delinquencies are up. We see that their restructured loans are upwards of 2.6%. They're starting to set aside more provision, which was one of the observations I made back earlier about in December was they're going to have to start setting some money aside. There's going to be some stress on the income statement. Our Century event engine catches some of these things. We can see this huge increase in modified loans from 67 million to 150 million. So let's go ahead and take a look at their loan book. Essentially, their loan portfolio is starting to climb again. We can see they fell all the way down to 5.27 billion, and then they've climbed, 4 straight quarters in a row. And so understand that part of a delinquency rate is going to be numerator and denominator, right? So if your non-performing loans are going up, but your total loans are growing at a faster rate, you actually end up with a delinquency or a non-performing loan rate that could drop. So it's always important to understand what's going on. So they're back into growth, right? And I can actually come in and take a quick look. If I basically come into this particular report right here, which is loan portfolios, and I essentially look at the quarter-over-quarter growth, I can see that they've actually shrunk their owner-occupied portfolio, 29 million. They've grown their non-owner. They've grown their C&I, domestic. They're growing their leasing portfolio extremely quickly, and mortgages. So they're doing some across-the-board growth. But let's go back and take a quick at the loan portfolios again. And what we're going to specifically look at right here is, and so you see the delinquencies are moderating. Now they're starting to climb. And then you see the restructured debt that we saw earlier that has skyrocketed from 1.17%, almost double, right? More than double, 2.58%. And what to look at is the loan portfolios. This is a really slick report. It basically is dynamic based upon the bank. So here we can see that Peapack's number one portfolio, their largest portfolio, is multifamily. Makes up 1.8 billion for 31% of their loan book. Their non-performing loan rate is 3.12. So what you look for is you don't want to see huge spikes. You don't want to see one portfolio making up 70%. Not that that can't work, and there's a lot of banks that are monoline lenders and they do a great job. But typically when you have one or two really super highly concentrated loan portfolios, it does put that bank at potentially risk if that particular segment of the economy starts to be problematic. So the good thing about this bank is 31% multifamily, 28% C&I, 17 CRE non-owner, and 11 residential, and then leasing at 4.7. So you're seeing a real nice mix. Unfortunately, the second thing that you look for is are the spikes red, right? So what we're seeing here is that 23% of their loan book, which are going to be those blue bars, represent that they're performing better than peers. The red performs basically as showing that they're underperforming. In this instance, it's significant. 3.12% NPL rate versus 50 basis points. And an important note here is we're getting the 99 closest multifamily portfolios on that size of 1.8. Then we're going out and getting the closest 99 banks on their 1.00 billion dollar non-owner. So this is very much an apples to apples, about as good as you're going to get. It's not the same peers across all groups. It's what is the peer group that is closest to their loan amount on every single loan book. And so what we're seeing here is they're considerably higher, more than 4, 5, 6 times, 2, 3 times, and double, right? In a couple of instances. So let's take a look at the multifamily. We see that this is a book they are getting out of. They have been declining that. It's kind of stabilized here at $1.8 billion range. If we come in and take a look at the non-performing loans, we do see that they're continuing to climb, right? And so earlier I had comment on this in the article as I was basically saying, look, there's a number of portfolios that are getting worse. This is one. So over here on the left, I'm basically going to show non-performing loan rate. But what we also see is they're starting to do a tremendous amount of loan modifications. So a couple of quarters ago, when I did this review, they were starting to do loan mods, but they had not done any loan mods in their multifamily. And to be clear, a loan mod is they're lowering the payment. Sometimes they put it on interest only, but essentially they're reducing the payment burden of the borrower to keep them out of delinquency. So they've modified $100 million in the last 2 quarters. 80 million of it is essentially is put on what's I call extend and pretend, right? That's the common vernacular. These are loan modifications that are left off non-accrual. Non-accrual, which means they're no longer recognizing fee and interest income, is sitting at right at almost $20 million. So there will be some overlap over here, basically on the delinquency. So what it does look like is essentially they're starting to restructure prior, right? That number hasn't changed. So if that number hasn't changed, if multifamily non-accrual has not changed, and it was on non-accrual, and the numbers 53, 53, and 56, and you come over here and you see the non-accrual jump, that has to be one of these guys from a prior period. So this is someone that was delinquent, or maybe not delinquent per se. They could have been. Most likely they were, but they could be put on non-accrual, not necessarily delinquent, although banks right now are typically avoiding that. But that could have been the case. But for whatever reason, part of that $54 million, they restructured 20 million of it. So in some ways that's good. They're lowering the payment, but it does show yet another level of stress, right? So really what you're looking at here is the combination of these two. So their delinquency rate continues to climb, and this is the loan modifications that are left off of non-accrual. And so this is additive. So what we're looking at is 3.12% of their book is non-performing, but another 4.5% is essentially been modified to keep it out of delinquency. So if we come in and we take a look at adding these two together, it's what we call portfolio stress. It's taking delinquencies, which are hard delinquencies, and adding in the extend and pretend. And we can see that the number's gone from the 53, 53, 50, 60, up to 90, up to 150. So a full 8% of their multifamily portfolio is either delinquent or been modified to avoid delinquencies. So what we like to do is take a look is, are they doing this across the board, right? So coming over here, this is non-owner occupied CRE. We can see that the numbers are, this probably is 1 or 2 guys. I mean, it looks very, very stable. Sometimes you're seeing the number go down every quarter, which means they probably are making payments, not huge payments, but they are bringing the number down. But over on the right-hand side, the same portfolio, we see 1.77, 1.8, 1.82, right? Because there's the growing denominator as they grow that portfolio. But basically, you're looking at another 1.77%. So the portfolio stress, they're reporting about 1.2%, but realistically, and that's going to be that number right there, but realistically 1.19, but we're looking at another $17 million on top of that. So now we have 2 portfolios. Let's go down and take a look at the third one, which is C&I. And so we come back over here and we're going to basically look at CNI, right there. So those are the three big portfolios that are showing some stress. So once again, the portfolio is getting noticeably bad, upwards of 4 or 5%. Did they start to charge off? Well, they weren't during that time frame, but they recently did take a charge off. But essentially what you're looking at, if we look at NPLs, once again, a recent increase, right? So something went from early stage straight into late stage. Now, this is where it gets complicated. Over here on the right-hand side, we see that their loan modifications left off non-accrual climbed and then went down. So this is where it gets complicated, because in some ways, this bank is going to do exactly what I would do, exactly what they're doing. The new rules for loan modifications allow banks. There was a lot of discussion back and forth since 2023 Q1 when they went with a new rule. But basically, it's now permanent starting essentially September. Banks can now do it in September. The guidance says December, but hey, if you want to do it early, go ahead in September. So this is the last real, and I put quotes around real because I'm not convinced, looking at the data, that a lot of banks are not already taking them. And I see it. I talk to banks. They are. A lot of banks are already taking stuff off if it's already been making payments for 12 months. So what would you do if you knew that you had a bunch of trouble in your portfolio and the rules were going to give you some relief in 6 months, 3 months? You would ramp up your loan modifications. I mean, that's what I would do. There would be a short-term spike. But really what you're doing is you're hoping that come 6 months from now, when Bill does his Q1 2026 review, that a lot of those modifications have fallen off. And all of a sudden you got a lower delinquency rate and no one really knows, right? No one knows that you've basically modified 6% of your multifamily portfolio, because that number will fall down. But the stress is still there. So in some ways, I kind of understand what they're doing here. But this is why this reporting change is so critical. We're going to lose knowledge, but the risk isn't going to go away. And it's going to start coming back. And I'm already seeing that in other banks. But one of the things we talked about with this bank last update was their essentially their reserves, right? So we are seeing, if we go back here on the left, take a look at the total portfolio, NPLs are climbing. They're climbing. Our charge-offs going up. Hit and miss. But you're basically looking at a lot of 2%, right there. So we've gone, when I did the update, it was 151. It's climbed up to almost 2%. So if we come into asset quality, we take a look at their reserves, this bank is increasingly becoming less and less reserved. They have increased reserves from that last update from 71 million to 81 million. Unfortunately, they've added 35 million of adjusted NPLs. And if you actually bring in the modifications that are being kind of ignored, and so I actually prefer to look at this one, they're sitting at 36 cents on the dollar. I mean, this is the lowest kind of they've ever been. You come down here, you look at all the other banks their size nationally, they're in the bottom, 96th percentile, right? They're in the bottom 5%. Even if you go and say, well, we'll be generous and take off the extend and pretend, the 71 basis points is still one of the lowest ever, right, for them. And then coming down, they're still in the bottom 10%. So regardless of what ratio you want to look at, straight up coverage ratio or adjusting it for loan modifications, this bank is not reserved. And so what is that manifesting in? It's going to manifest in them having to set aside more provision. And so right here, we could see when we did that earlier review, the bank wasn't setting aside enough money. I mean, their delinquencies are climbing, and yet they're still managing income. Well, why are they doing that? Because they're managing income. So if you come in and look at pre-tax, you can see that the increase in provision is going to continue to wear on this bank's ability to generate income moving forward. As always, if you have any questions, please reach out and give me a call. Thank you.